Kind of whoosh lower at the opening trade. Nasdaq still below 11K. Let's get to Bob Pisani. Morning, Bob.
Good morning, Carl. Happy Tuesday. 8 to 1 declining to advancing stocks. And if you're in the rotation crowd, you're going to be disappointed today because it's really not happening. Yeah, tech is weak, but energy, 4 days in a row down on oil, down 7% today. Yields lower, banks are getting hit. So that rotation argument is not really holding up that well today, just generally weaker. But the emphasis on the weakness in techs. And remember, there's some headlines out there. Those comments from President Trump seeking maybe additional decoupling, his word, from China, that's not good for Microsoft. It's not good for any of the semiconductor names, not good for Apple. So you see all those names down here today. And the work from home stuff, again, down 2 to 3%. And what you don't notice here is the last few days have been really, really tough on the whole work from home crowd. So Salesforce, DocuSign, all those stocks to the downside. Slack's just up a little bit here. But we've got a healthy correction going on in this sector overall. And it's more than a few percentage points. Just let me show you from the 52-week highs now. And some of these have been a round trip in 7 or 8 trading sessions. But Slack, Wayfair, more than 20% off their highs. DocuSign, Zoom Video, even NVIDIA. PayPal's probably down 10, 11% as well. Salesforce is probably down 11 or 12% off of its 52-week high. So we've got a serious correction underway in some of these names here. They tend to overshoot. I talked about this at the end of last week. So look at DocuSign, for example. 220 6-7 days ago to 280 or so on one day and blow off top. And essentially we were at 200 this morning, a little bit over that. But you can see you could all the way up, all the way down. We were even below 200 at one point, I think, this morning briefly. So you can easily overshoot on these corrections. Overshoot on the way up, overshoot on the way down on these blow off tops. But it's not insane that tech has been doing so well. I keep emphasizing the third quarter numbers are coming out very soon. We've got estimates. And basically technology is flat for the third quarter compared to the same period last year. Think about that. That's quite amazing. And with everything else out there, look at the financials down about 26% for their earnings for the third quarter compared to the same period last year. Industrials down 65%. Energy, you're looking at, that's not a typo, 106. Companies have negative earnings. You're actually losing money that are out there. So it's not insane that technology stocks are doing so much better than the rest of the market. Just on an earnings basis, they're clearly outperforming. As for the S&P 500, I know everybody's focused on Tesla, but the S&P keeps changing to reflecting the world and the way it is. And the way the world is a lot less retail and a lot less energy generally out there, although energy stocks are not being deleted. But Etsy and some of the other ones that are being put in there, a tech energy, Teradyne, of course, a chip maker. And, of course, we've got some other ones that are in there as well. Of course, essentially, Catalent does drug delivery devices, helping companies, new technologies for drug delivery. It's a tech-oriented pharmaceutical company. And the deletes out there, it's the tech names. You've got Coty and Kohl's. Those are the 2 or 3 lowest market cap stocks in there. I think H&R Block is the lowest market cap. That's not a retail stock. But the main point here is the S&P is evolving to reflect what the country is looking like. And generally, retailers, old school retailers are out. Remember, there's a lot of them that have been thrown out this year. So we had Macy's, we had Capri Holdings, we had Urban Outfitters, we've had Nordstrom's, we've had Kohl's, we've had Cody's. And I'm surprised, frankly, Carl, that we haven't seen some energy stocks out there. We've got Marathon sitting down there, Devon, that are very low market caps in the $5 billion range. That's typically when they start really getting into trouble. And, of course, that's what happened here today with Cody's and with Kohl's. They were essentially market caps $2 or $3 billion. Hard to believe when you're dealing with a company like Apple with $1 trillion market cap that there's companies with $2 billion, $3 billion market caps sitting in the bottom of the S&P 500. Of course, they are responding to that. They're changing the composition. Carl, back to you.